Great, I think we are ready to kick it off here. Welcome to Carbon Tracker's webinar to discuss our latest report that was published last week called Double or Nothing: How Regulators Are Gambling on the Future Self-Interest of Large Oil and Gas Companies to Decommission the Gulf of Mexico Aging Infrastructure. If you haven't already, please download the report from our website, carbontracker.org. My name is Henrik Ebbesen. I'm Head of Investor Outreach North America for Carbon Tracker, and I'll be moderate today's discussion. This report is the latest in our series focused on asset retirement obligations, AROs, i.e. the potential liabilities connected with cleaning up and decommissioning upstream oil and gas assets at the end of their productive life. This work stream was launched back in early 2020 with a report called The Flip Side: Stranded Asset and Stranded Liabilities, which are also available on our website. With today, we have two speakers with us. That is Stephen Greenslade, our Asset Retirement Obligation Analyst, and Rob Schuwerk, Executive Director for North America and heading up our work on asset retirement obligations. Quickly on the agenda, first we'll hear about 20-minute presentation with the key conclusions from our latest report, Double or Nothing, by Stephen. And then there will be a Q&A discussion between Stephen, Rob, and myself, and we will open up to the audience for questions, and we look very forward to all of your questions. First, a couple of housekeeping items. This webinar is recorded and will be shown live as well, I think, on YouTube and LinkedIn. Slides can be provided afterwards upon request. And if you want to ask a question, please use the Q&A function at the bottom of your screen. And then please ask questions, as your questions are really helping us shaping our future work in this area. So for those who are not already fully aware, Carbon Tracker is a London-based independent financial think tank. We were launched in 2011. We are analyzing the impact of climate change and the financial material risk and opportunities from the energy transition towards a low carbon economy, and the impact and effects that will have for capital markets, companies, and their investors. Research, yes. So our research is focused on the supply side of carbon emissions, as most carbon emissions originates from burning of fossil fuel, oil, gas, and coal to generate energy. When Carbon Tracker was launched a little more than a decade ago, back in 2011, our fundamental insight was that the oil and gas industry's growth plans do not fit in a low carbon world. In fact, if we wanted to stay below 2 degrees Celsius temperature warming, we have more than 5 to 7 times available emissions embedded in already proved fossil fuel reserves than we can burn. Thus, if the world wants to reduce the worst consequences of climate change, then most of the oil and gas, coal reserve and resources should stay in the ground to prevent creating stranded assets and wasting capex and avoid the carbon bubble. In other words, we can burn them all. In 2018, we then turned focus onto the overall energy transition and the impact from new energy technologies and manufactured energy, solar, wind, batteries, etc., where sharply declining cost structures started to outcompete and replace fossil fuels, irrespective of climate consideration. In other words, we won't burn them all. So now we are coming to really where we come to today's topic, which is really about decommissioning risk. Because unlike most sectors, oil and gas companies are legally obligated to decommission their assets in accordance with our environmental standards at the end of their productive lives. Accountants call these liabilities for asset retirement obligations. So as we go through the energy transition, we are seeing that the energy transition actually accelerates these decommissioning risks. We exemplify this here with electric mobility, because lower prices of batteries are boosting their deployment and rollout in more electric vehicles, which again are lowering the prices, which again boost their deployment, etc. So we have a positive spiral happening here. This accelerates the adoption of electric vehicles and other electric mobility methods. This has a big impact on the demand for oil and gas, especially for oil, because around 60% of the oil barrel are being used for gasoline for transportation. And the same observation we have done when we look at solar and wind displacing the demand for gas and coal for power generation. So both from an economic and a climate point of view, long-term demand for fossil fuels are likely to fall, whereas the supply side remains largely unchanged, as the resources are still staying in the same place in the ground. We believe this dynamic will likely lead to a fierce competition among suppliers about who will meet this dwindling demand for hydrocarbons. That makes a production cost a very key indicator for the future viability for the sector. But also, lower oil and gas demand will accelerate and move forward the time of retirement of oil and gas producing assets, as mentioned before, because they have a legal obligation to decommission these costs. Under business as usual approach, these asset retirement costs can lie decades out in the future and are not liabilities for which companies are currently making provisioning. Hence, companies are not saving for these retirement costs. Instead, they are paid on a pay-as-you-go basis based on operating cash flow as part of their normal business, because they all believe they will continue to grow their business, i.e. there will be more cash flow in the future. This assumes going concern, and companies will not prematurely have to retire producing oil and gas assets due to lower demand, as we have highlighted is a very likely scenario when we look at the adoption from and the consequences of the energy transition. And that overall assumes that future operating cash flow will be available. If not, this could lead, or maybe tempt, you could say, companies to file for bankruptcy and pass the buck to government or to the society. So, with dwindling demand, reducing operating cash flows, combined with earlier payment of retirement costs, this raises a very important question, both from an economic, environmental, regulatory, and legal point of view. Who will pay this cleanup bill? In the US, onshore, we have focused in a number of reports prior to today on the state regulators, because onshore it's all regulated by the state. They require insurance in form of surety bonds. But as we have found, these surety bonds are they only cover a fraction of the estimated decommissioning cost, and also assumes that the companies can actually pay for these costs. And many of these companies are self-insured, which causes a problem. So the big question for all of us here today is, as energy transition reduce operating cash flow that are currently assumed to pay for these decommissioning costs out in the future, who will pay, how will they pay, and when? For the onshore world, we know that taxpayers are potentially at the hook if state regulators are not good enough at designing their regulation and make sure that they have enough coverage to pay this obligation. But what about offshore? This is the topic of today's report and today's discussion, Double or Nothing, in which we are focusing on the decommissioning liability exposure for US offshore oil and gas activities. And also we will take into a twist, which is focused on whether the parent oil and gas company can avoid paying the liabilities and covering the liabilities created by its own subsidiaries. So let's go to the next page. So just to highlight a couple of key conclusions from today before I hand it over to Stephen to walk us through the actual details. Then, as talked about, energy transition will help accelerate the timing of these decommissioning risk. When we go deep into deeper water, the cost of cleaning up increases. We have found at best 10% of decommissioning costs are secured by bonds. That means a big exposure. But the concept of joint and several liability, that creates a different narrative. What does that mean? It means that any co-owner or prior title or operating interest owner can be held liable for the entire cost of decommissioning. If we include this risk, then the risk actually increases by 2 to 7 times compared to the direct liability of current leases by the largest companies. These are not generally reflected on balance sheets, and these are counted in billions. Current policy creates an investor subsidiary gamble, basically who owns what and who has exposure to what in the future in history. That is important for you to pay attention to. So bottom line, where do you want to place your bets? Who will policymakers, who are they most afraid of upsetting? Taxpayers and voters to pay the cleanup bill, or the oil and gas producing companies? These are important areas for oil and gas investors to be aware of, but also for regulators to decide how they're going to form and dictate their regulation going forward. With this, I wanted to hand over to Stephen to take us through some some of the more detailed discussion of the report, and then we'll open up for questions. And please use the Q&A button as said, and we are looking forward to all your questions. Stephen, over to you.
Hi, thanks very much, Henrik, and thank you all for being here today. I look forward to going through this research with you, and yeah, please hit us with your questions, because we'd love to hear how this information is landing for you. So I'll give you a brief overview before I get into some of the details. So for this project, we essentially sought to build our own data system to understand liabilities in the Gulf of Mexico. Our objectives here were to understand the current state of offshore oil and gas development and regulation, and to explore how joint and several liability impacts liability risk in terms of the distribution and the scale of that risk. We use publicly available data from the federal offshore regulators, which includes the Bureau of Safety and Environmental Enforcement. That's BSEE. You'll hear me throwing the term BSEE around. The Bureau of Ocean Energy Management, BOEM, and then we also used data from the Securities and Exchange Commission from financial filings in order to kind of aggregate conglomerates and corporate groups under their holding company umbrella. With all that data, we developed a chain of title for all of the leases in the Gulf of Mexico to understand who owned what from as far back as data goes to the 1940s to today. And that's for every lease and asset in the Gulf of Mexico. And then to understand how much each of those leases will cost to decommission. And then with these data sets in hand, we performed our analysis on how decommissioning costs are distributed among companies operating in the Gulf of Mexico. And we examined whether current offshore regulations appear sufficient to protect the public from private cleanup costs, especially in the face of the energy transition. So let's get to some of the background details here. To really understand the Gulf of Mexico for this report, we had to contextualize the secular trends broadly termed the energy transition against relevant industry trends offshore. The Gulf of Mexico has long been a major hydrocarbon producing region for the US, but is now in decline, as you'll see in this chart on the left here. And you'll also notice, if you can look closely, I don't know how visible this is, that production is used to be very heavily weighted in shallow water, and it's moving very much into deeper water here. So taken as a whole, the GOM is past peak production, GOM, the Gulf of Mexico, and there's really little prospect for that trend to ever meaningfully reverse. As shallow areas have been drilled out, development has moved into successively deeper zones where costs to develop are far higher and costs to decommission are far higher. Generally speaking, shallow zones in the Gulf of Mexico are very old and pretty depleted, with only marginal economics, and the deeper fields, as I mentioned, are far costlier to develop, requiring long investment horizons to generate a return. And then the cost to plug deep water and ultra deep water wells is several orders of magnitude higher than in shallow water. The Gulf of Mexico thus can be split into two more or less groups in terms of the wells, the well typologies, with distinct but equally salient exposures to energy transition risk, though these groups are actually bound together because of joint and several liability, which I'll discuss more in a minute. So BSEE, Bureau of Safety and Environmental Enforcement, has developed a sophisticated method for estimating the cost to decommission the infrastructure that remains in the Gulf, which is great. You can't really regulate this unless you understand the scale of the issue. Total estimated costs to plug wells and decommission platforms and pipelines is currently expected to be somewhere between $34 and $48 billion, depending on the probability tier in BSEE's model. For example, the P50 cost tier, that represents the cost at which there's a 50% chance that the actual incurred cost will not exceed the estimate. If that makes sense. The cost model is trained on data only going back about 5 years. So that does leave the possibility that actual costs could trend higher than what might currently be expected, because most of what's been decommissioned recently is very shallow relative to what exists out in the farther reaches of the outer continental shelf. But we focused on the P50 costs in this report in order to offer what we view as a conservative and defensible view of what the risks are. And depending on the cost tier that you select, bond coverage in the Gulf of Mexico is only around 10%, which means only about 10% of the estimated costs are covered by real financial security, although effective bond coverage is actually somewhat lower than that. You know, obviously, that's an issue that we have to grapple with here. The picture is quite a bit bleaker when we look at only the top companies operating in the Gulf. So the top 10 publicly traded companies only show bond coverage of around 1% on average for their direct liability, which means for the direct liability allocated to each of these companies, only in proportion to their current lease title interests, only about a penny on the dollar is held in security to protect taxpayers from the cost, which is it's a condition known in the industry as self-bonding, in which the largest companies are deemed financially capable of fulfilling their statutory decommissioning obligations, and thus they don't have to provide actual collateral to protect the public. These cost figures, however, do not consider the impact of joint and several liabilities. So the blue bars here, that's what we estimate their direct liability is based on current leases. However, under joint and several liability, any co-lessee, co-operating rights interests, or predecessor company can be held liable for the full obligation that accrued under their ownership of the lease. This means that if I own or operate a well and sell it to another company, and that company goes bankrupt, the government can come to me to fulfill all the retirement obligations associated with that well. Based on our analysis of BSEE data, 78% of all decommissioning costs in the Gulf of Mexico are linked by joint and several liability to the top 10 publicly traded companies, which amounts to about $27 billion of the total cost at the P50 cost tier, and over $37.5 billion at the P90 tier. On its face, it appears that the federal government has put the burden of ensuring that the Gulf gets cleaned up onto a handful of private companies. And you'll see if you look through some of the other metrics for these companies, the magnitude of joint and several liability ranges pretty widely across the top public operators, but it generally equates to billions in additional contingent decommissioning costs. As a multiple, joint and several liability ranges from around 2.3 to 6.8 times direct liability for the top operators. As the energy transition accelerates, the likelihood that joint and several decommissioning liabilities will fall to the top companies is going to grow. These contingent costs are generally not reflected on the balance sheet today, nor anywhere else in financial filings, except occasionally as an unquantified potential business risk. And this isn't in contravention of accounting rules. Accounting rules do not require disclosure of contingent liabilities deemed unlikely to come due, but the magnitude of these costs and the nature of the underlying risk drivers should be cause for concern to investors and regulators, for all the reasons mentioned by Henrik at the beginning. Industry fortunes can turn very quickly as a result of compounding secular trends and unpredictable global events that can drive waves of bankruptcies, as has seen in recent oil downturns and multiple waves of bankruptcy in the coal industry. And as long as there's a future upside, some value for these companies can be salvaged in Chapter 11. But the energy transition, driven by technological changes, shifting consumer preferences, raw market competition, and the ratcheting up of global policies to combat the climate crisis will progressively limit future upside potential, especially in old and or high-cost regions like the Gulf of Mexico. And all of this simply means that a large share of the joint and several liabilities can reasonably be expected to shift onto the balance sheet of the top companies. Now, it should come as no surprise to folks who are intimately familiar with the top oil companies globally that the actual legal entities pulling the oil out of the ground in the Gulf of Mexico are not the ones filing the financial statements. They are subsidiaries of the multinational holding corporations. And we made an effort in this analysis to consolidate all subsidiary companies listed in BSEE data under the top 10 companies in order to aggregate liability, which makes sense because asset retirement obligations are reported on a consolidated basis in corporate filings. And when we did this, the pattern we noticed, generally speaking, is that production and liability are concentrated among one or two major subsidiaries. Those are essentially the current operators, with a range of other companies holding some bonds and some varying levels of liability exposure, especially joint and several liability exposure. However, the catch here is that in the absence of guarantees by parent companies or assertions of alter ego liability in order to pierce the corporate veil, joint and several liability is limited to the subsidiary whose name is signed on the lease. In other words, Shell Pipeline Company LP is not responsible for Shell Offshore Incorporated's leases unless it is also owned an interest in those leases, unless it is also jointly and severally liable in the classical sense, and vice versa. And furthermore, Shell PLC, the parent company, is not necessarily responsible for either Shell Pipeline, Shell Offshore, or any of their other subsidiary obligations. Some subsidiaries appear to hold over $1 billion in contingent liability, but show no current production. And many companies listed by BSEE and registered in the chain of title analysis that we performed do not appear to exist anymore in any meaningful way. Now, red flags aside, the system has worked in the recent past in order to protect the public purse, with Fieldwood bankruptcy being a great example. Apache Corp, now APA, among others, have been charged with fulfilling billions worth of cleanup obligations for the Fieldwood Energy as a result of their more recent, their 2020 bankruptcy. And this is despite Fieldwood being listed as one of the top producers for 2021, just by the way. So it seems that the system works well enough while the Gulf of Mexico is a profitable place to do business with deep-pocketed companies to come to the rescue. But in the face of field decline, rising development and operating costs, and the inevitable impacts of the energy transition, it's a very risky bet that these subsidiary companies will be as financially healthy in 5 to 10 years as they are today, let alone the smaller companies that have bought up older assets from the top players. When economics shift and Gulf of Mexico operators start to fail, what incentive do the parent companies have to bail them out to the tune of potentially tens of billions in cash costs as a group associated with plugging and decommissioning worthless infrastructure? Now, for all the complexity in the data and terminology here, the message is quite simple. There isn't nearly enough cash set aside to ensure that the Gulf of Mexico is decommissioned in a timely and efficient manner by the legally responsible parties. Joint and several liability means that companies and investors are at risk in the short run because the top publicly traded operators are on the hook for a huge share of the cost to clean up the Gulf of Mexico. Investors should take stock of these risks and explore measures to limit exposure, and should carefully track policies that could impact their investments. Now, on the other end, the public is exposed to potentially tens of billions of decommissioning costs because, for one, the Gulf of Mexico has a limited economic life ahead of it, which will likely be cut short due to the unique transition risks facing the region. And two, the parent companies that ostensibly will outlive their Gulf of Mexico subsidiaries may not technically be on the hook in a lot of instances. Now, the potential chaotic cascade of liabilities demonstrated by the recent Fieldwood bankruptcy is just the taste of what's to come. And as decommissioning obligations filter back up to the top companies via joint and several liability, it's increasingly likely that the top oil producers will decide it's not worth it to clean up the mess. So, as a final recap, top producers face joint and several liability that dwarf their expected costs, and those costs are not reflected on the balance sheet today. Bond coverage is low, so no cash is set aside for retirement. Regulators are relying on top companies to make sure the Gulf of Mexico gets cleaned up, which could impact investors in the relatively near term, as happened with Fieldwood. But as the energy transition progresses, it's going to look like an increasingly distasteful outcome for parent companies who may have the option to walk away. And last, but certainly not least, we focused on the Gulf of Mexico in this report, but joint and several liability is relatively common for offshore fields around the world, meaning that the full global impact on these top companies, all of whom have global offshore presence, could be quite dramatic. And that's it for the slides. So thanks very much for your attention. Let's move into some questions.
Fantastic. Thank you, Stephen. And just to repeat that, if you use the Q&A box at the bottom of your screen, you can put in the questions, and then we'll take them as they come in here. But maybe I can sorry, kick it off here a little bit in the beginning, just maybe if it would be great, because we've done a number of reports focusing on asset retirement obligation, both onshore and offshore here. Could you try and quantify here, maybe upfront, on like what have you found to be the difference in cost of these decommissioning costs for, you say, for a typical onshore versus a typical offshore well?
Yeah, it's a good question. I mean, the cost to plug an offshore well is far higher, but there's a range of variability here. You know, while onshore there can be quite a range of variability, which, you know, generally is reflected by either, you know, primarily the depth of the well, but also, you know, whether or not there's extensive surface remediation, reclamation required. Offshore, as far as you know, by far the main driver is how deep is the water that we're operating in. You know, a single well in deep or ultra deep water can cost tens of millions of dollars to plug. That's, you know, that's relatively routine cost. Whereas in the shallower zones, it might be a couple $100,000 more in line with a high cost well onshore. Did I answer your question?
Yeah, no, that I think that was a good to try and get some money on the area here. So maybe just to go back, so Gulf of Mexico, that's what we have focused on, and I think it fits very well with I think what has been going on for a while. So when I originally started out being on the dark side of investment banking, I was helping oil and gas companies raise capital for new exploration and new drilling equipment, and that was back when the world was running out of oil supply 15, 20 years ago. And the big mantra back then was further, longer, deeper, especially offshore, and that's also what we have seen here. So you're calculated on the largest 10 companies. You try to consolidate it on here, but how many other companies? Is that primarily small mom and pop type operation, privately owned companies which have not listed, we don't have easy access to capital? And then maybe as part of that as well, it's interesting to see that you found that in general 10% are bonded off the offshore cost, but for the 10 largest, which you also said had a very big coverage, it looks to be only around 1% coverage. So what is going on here, and is that because the U.S. government expect the big oil majors to stay alive for a very long time?
Yes, for second question, absolutely. Part of how they determine financial assurance requirements offshore is with financial stress testing of the companies, essentially. And so the biggest, strongest companies bond at a much lower level than the smaller companies. As for the question of how many other companies there are and what share of the Gulf of Mexico they represent, the top 10 that I mentioned, if I recall correctly, account for somewhere around 72% of production in the Gulf of Mexico. There's another 60 or so companies that are listed as having any production at all. And this is based on lease allocated production, not operated production, which is what's reported on BSEE. So we looked through all the lease owners and allocated production from those leases to the owners proportionally. And so found that there were somewhere around 70 odd companies that had any production at all. And so the top 10 were, you know, essentially 3/4 of production, and then everybody else represents that last slice. So there's, you know, it tapers off pretty rapidly there. Was there another part to this question that I'm forgetting?
No, I think that covers what we wanted here. There was a question come in here, which I think is also quite important to get in here. Are the liabilities you show, are they in nominal or real terms? And if nominal, based on your view of when liabilities would be incurred, to what extent would these be discounted?
So the way Bessie reports these is essentially in today's dollars. If we had to plug these wells today, so they aren't discounted in the way that asset retirement obligations on the balance sheet are discounted. They are still estimates that are based on past, recent past receipts from private companies. So there is still certainly some uncertainty about what the actual incurred costs will be for different assets. But I think that covers the basic questions that these are supposedly reported by the federal government in today's dollars.
Fantastic. And then one topic that if we look at some of our onshore discussion about onshore wells, there's a lot about abandoned and orphaned wells. You also touch upon that in the report here, but how big is the issue with abandoned and orphaned wells in Gulf of Mexico, which I guess is really in federal waters and federal regulators compared to onshore, which is more done by the individual states? Is that a big issue here for the decommissioning cost?
We just read a pretty great report by the Center for American Progress that mentioned that in the coastal waters managed by the states, there is an orphan well issue to be addressed. Because of joint and several liability and because of some other recent updates to the regulations, orphan wells have not been as much of an issue in the federal offshore zone. Because when you tie other operators, it just reduces the chances that you won't be able to find a responsible party.
Gotcha. And then so now questions are starting to come in that we appreciate that. So maybe another question, which of course is quite interesting here as well. When we look at the joint and severable liability here. So if you have listed companies, are they also, so basically they are also responsible for if any of the non-listed operators can pay. What about some of the state-owned operators? If we look at Equinor and these type of companies are also, you would say, somewhat involved. Maybe they are not the one who are at risk here, but how wide is that joint and several liability? Is it for everyone? And maybe we can touch upon what is the learnings we know from the APA or Apache situation. How much will this end up in litigation? Is probably ultimately the question.
Well, I think litigation is certainly inevitable anytime there's a bankruptcy. Rob, if you want to jump in on this question.
Yeah, go ahead. I'll go after you. That's fine.
Okay. As far as how is joint and several liability distributed among publicly traded, state-owned, joint and several liability is kind of agnostic to ownership structure. It's just how many leases have you owned that still have decommissioning costs attached. Now, incidentally, the top producers today also tended to be among the top repositories for joint and several liability. There were a couple other companies like CNOOC, Chinese National Oil, had a very large production and joint and several liability profile. But for the most part, what you see with the top producers today, they're also the top holders of joint and several liability. Although, it's also true that every company that has any history in the Gulf of Mexico to some extent is exposed to added costs potentially.
Okay. I would just add from a regulator's perspective, I think, joint and several liability is a net positive in the sense it's better than having nothing at all. But it's a far cry from being able to have actually cash in hand or cash equivalent in hand covering these costs. And part of that is, the litigation risk is end up in litigation, as you pointed out, or as you asked about. And there's all kinds of room for mischief. We don't go into this in the report, but, typically people are responsible for only their, the infrastructure that was there during their tenure of ownership. So if someone were to create new infrastructure after the fact, they wouldn't necessarily be liable for that. Well, that gives room for all kinds of litigation, really wasted resource about who was responsible for what, when things were built, so on and so forth. Some of that granularity is in the data, and we've tried to accommodate that in the numbers that we present in the report. But there's all kinds of room for litigation, including between operators on those various issues.
Great. And then we have a question here about, so isn't 35 billion an easily manageable for some of the big oil companies, especially if you look over the next 20 years? I think BP spent over 65 billion to clean up after Macondo. And given the current very high oil prices, the 5 super majors generated around 54 billion in operating cash flow in Q1 alone. So is this a very big issue, or how should we look at this?
Yeah, there's a couple responses.
Yeah, I would. No, go ahead, Steve. Go ahead.
Yeah, I think for one thing, decommissioning costs are different from operating costs in that they come due at the end of the life of an asset. And so by definition, they come due after the underlying cash flow is gone. If money isn't being set aside, profits today are irrelevant for what cash flow is going to be available in 5-10 years. That's a key issue with decommissioning costs, and it's what really is part of the regulatory frankly, regulatory failure on this issue is that there's all this assumption that these oil companies will continue as a going concern forever. We've noted that the energy transition fundamentally changes that dynamic. And it's certainly when we consider that the subsidiaries could be ball and chains that end up getting cut from their parent companies, there's really no reason to expect that these massively profitable multinationals are going to proactively set aside these funds if they aren't required to do so. So that's one thing. Rob, did you have an additional point to add on to this?
Well, I mean, I think the other thing is, yes, so you've got a timing issue, and so these are to be decommissioned probably in a period where these companies are not experiencing 54 billion in cash flow in Q1. But you also have to think about this as a fraction of the total picture for any of these companies, right? This is just the Gulf of Mexico, and we're talking about 35 billion. These companies have infrastructure onshore, all around the globe, other places, and so I would be looking at the multiple and deciding whether that's significant. Thinking about the issue globally.
Gotcha. Then we have another question here, which ties into some of the things I wanted to raise as well here. But you described the subsidiary game. By that term, do you mean that parent companies are gambling that regulators won't be able to pin a subsidiary liability onto their ultimate corporate parents? If that's right, what is needed in terms of new law, clarification of existing law, etc., to reduce the odds in this gamble?
Yeah, that's a fantastic question. It really gets to the heart of the regulatory issues here. I think there are a couple of ways of dealing with this. The number one that we advocate for is requiring full financial assurance for the decommissioning of all of these assets. As mentioned, Keith, right now there's a ton of cash being generated by these companies. It would not be a major impact to them today. It wouldn't send ExxonMobil into bankruptcy to be forced to set aside, $5 billion to decommission their Gulf of Mexico assets. However, they're not being required to do that today. Now, full cost financial assurance would solve that problem, and it would additionally solve this issue that joint and several liability can potentially produce these sort of chaotic cascades that have sort of unpredictable impacts. an additional strategy that certainly is less complete in its capacity to foreclose this issue entirely, is to require the parent companies to legally guarantee their subsidiaries. That removes any question of whether or not Shell PLC is going to cover for Shell Offshore Inc. So that's an option, although ultimately, I think the best strategy is full cost financial assurance.
The only thing I would add to that is getting the full cost financial assurance would have an ancillary benefit for operators that have lots of non-op working interest owners. It may be under some of the agreements between working interest owners that they cannot make a call on retaining a asset, collateral to deal with the asset retirement obligation unless they're required. And if there is a regulatory requirement, then they can go and get that. And why does it matter? The operating working interest owner is kind of, in some ways, like the way that the regulator and the taxpayer sit vis-a-vis these liabilities. If they operate and own a share in an offshore platform, and there's a bunch of other working interest owners, they're just passive. They are going to, they run the risk that those people will not be good for it at the end. In many ways, this could actually benefit operators.
Got. Yeah, I think you cut out at the end here, but maybe in the next question then. So we've already had a couple of call to actions, and as part of that call to action, I'm also asking if there's more question coming in. That's always great. We have some good question already, and we have some good one coming here. But what can investors do to stay on top of this issue? And are there any current regulatory developments that we should be aware of and pay attention to when we look at the offshore sector?
So there's not a rulemaking underway right now, but it is a priority for the Department of the Interior to pursue a rulemaking around financial assurance in the Gulf of Mexico. So I would say the number one thing is to watch that, and certainly anybody with an interest should provide public input in that process. Because the way the federal government chooses to change those rules is really going to have an impact on how you measure those risks. But then more broadly, understanding how the web of joint and several liability looks offshore, understanding these potential contingent costs, that's an important thing, and that's something that you can take into shareholder meetings and ask companies to be more forthright in their disclosures, in order to really understand, like, well, what's the potential that, like with Apache, we could have a quarter profits get knocked off the books just because some of our former fieldwood leases boomerang back to us.
And to what to your knowledge, what are regulators? How aware are they of these issues? I know you've done some work on some of the state level across the country, but how aware are they both, and also when we look at the offshore on the federal level? Are the regulators discussing this already?
I'm not privy to the internal conversations at Bessie and Bowen, but you can see in some of their recent published reports that there is an awareness that the current rules are not sufficiently protective in all instances. And so, I think certainly amongst staff, and probably at this point among a lot of leadership in the Department of Interior, I would be surprised if there weren't some kind of internal machinations around this issue currently. But as I mentioned, I'm not a fly on the wall in those conversations, so I can only speculate.
Great. And then we had a question just for clarification here. If you could explain again how these liabilities are not required to be disclosed in the parent company's financial accounts. Yeah,
so direct liability is essentially, we with our report here, we kind of created a proxy for what we estimate they should be reporting. So what they have to report is their direct decommissioning liabilities. What assets do they own today? How much is that going to cost to clean up? Of course, they discount that, and so it's not a direct, you can't read the ARO and say, oh, it's going to cost $5 billion for them to clean up their entire portfolio. It's a little bit more complicated, and sometimes it's impossible to ascertain the full undiscounted amount. However, so that is to say that AROs are disclosed. Contingent costs, contingent liabilities are not disclosed unless it is deemed by management that there's a high probability of those costs being incurred, and that those costs can reasonably be estimated. Now, the estimation issue is off the table here because we know what the costs are. However, for these contingent costs, if Shell sells some leases to Murphy, I think they can right now reasonably say we're not at risk of that cost coming back to us, and so they can shed that from their balance sheet. They don't have to report that.
Got yeah, and maybe a little related to that, and maybe to some of the work that you otherwise are doing. So how can investors then work on trying to include this joint and severable liability risk? How can they find numbers and do an analysis and try to get these things into their discussions with companies? Is that information that we are providing, or that they have to go out and get themselves, or how should they go about it?
Well, I think it is a future project for us to expand our disclosure of some of the data that we produce for this report. We do have joint and several numbers for every operator in the Gulf of Mexico. So if folks are really interested, feel free to reach out to us, and we can provide that information. Otherwise, for folks who are enterprising and handy with data sets, it all is generated off of publicly available free data from the Bureau of Safety and Environmental Enforcement. I'm happy to discuss methodology with anyone's interested in reproducing that and potentially working those contingent costs into models that they're already developing regarding how the energy transition is going to impact some of these companies.
Great. And then maybe the last question from me, unless there's anything coming, any other questions coming in here. So we have alluded to it a couple of times. So in this report, we are focused on U.S. Gulf of Mexico. There are other offshore areas in the U.S. which, although not as big, but what can we say about other offshore but also onshore jurisdictions around the world when it comes to potentially underfunded asset retirement obligations? Because this is not an isolated U.S. issue, and if you can talk a little bit about some of your thinking in the area, what are the top priorities we should have in this area, and where would it be great to know more about the potential liabilities?
Maybe I could take that one. So, I think, so a couple things. You've got infrastructure issues. We focused on the upstream, but you've got infrastructure issues in the midstream and downstream. There are retirement obligations across the entire value chain. Companies only have to report on these direct liabilities. If they can't estimate the useful life of an asset, it has an indefinite life, you're not going to see that on the balance sheet. So you see a lot of pipeline midstream companies not reporting any AROs. And the reason isn't because they don't have the obligation. The reason is because they say they can't estimate how long it's going to live. The whole system really has been set up on the assumption that assets will be retired as you go, that those will be retired using cash flows from future oil and gas projects. And this will go on ad infinitum, right? It will be the long tail of over 100 years of growth in the sector that's going to allow you to pay for and retire earlier assets. And the energy transition just makes that an untenable proposition going forward. We're not going to see the growth, future oil and gas projects that would, that are going to be sufficient to pay for it. It's kind of like, if people stopped having kids, what would happen to Social Security? So I think it's really, the issue is we've got to solve this problem now. There is no time like the present where companies are making money to say, look, we've got to set this aside. And so, and that is an issue that you see globally. There are variations globally in terms of regimes that allocate some of the cost to governments and other things. I mean, there are some differences, but by and large, you will see regimes like what we're showing in the Gulf for offshore jurisdictions elsewhere, where there is joint and several liability and the possibility for these all to come back to, often a handful of companies that were pioneers in those plays.
Fantastic. Thank you so much to Stephen and to Rob for this walkthrough. This is definitely an evolving topic. There's a lot of new numbers and new, I think, angles to this here that it probably is also new information for a lot of investors. Hopefully not for the regulators, although it could look like it. So with that, I would like to say thank you to everyone. Thank you for the incoming questions. Stay tuned for more information on asset retirement obligation and other areas within the energy transition development and involvement from Carbon Tracker on our website, carbontracker.org, and also from our newsletter. Please reach out to us if you have questions, and if you would like to see the slide presentation here as well, then also please reach out. And with that, I would like to end today's presentation. Thank you so much to everyone. Have a great day.